Silver just did something that would have sounded impossible not long ago. It flashed down near $61 an ounce, then turned around and ripped higher. And if you only look at where it's trading right now, you'd completely miss how violent the move actually was. The intraday swings are getting so extreme that one day is starting to look like an entire month of price action compressed into a few hours. So what's really driving this? Why are we seeing these sudden drops and snapbacks in both silver and gold? And while prices whip around like this, why do US silver stockpiles keep draining? And where is that metal actually going? On top of all of it, the national debt is still climbing, and government spending doesn't look like it's slowing down. When you put all these pieces together, what does it mean going forward? Let's walk through it step by step, because the details matter right now.
As I'm recording this, silver is trading around $69.30, up about $1 on the day, roughly a 1.5% gain. On the surface, that sounds calm. It sounds like a normal green day. But that headline number is basically useless if you're trying to understand what's happening, because the real story is hidden in the one-day chart. Overnight, silver dumped hard. At one point, it traded all the way down to roughly $61 an ounce before bouncing. Think about that for a second. From the high $60s down to $61 and then back up again, inside of a single day. That's not a gentle pullback. That's liquidation followed by an aggressive reversal. And it wasn't just silver. Gold did something similar, just with different direction on the day. Gold is sitting around $4,386, down about $111, roughly a 2.5% decline. So you've got this weird split where gold is red and silver is green, but the intraday behavior is telling you both markets are in the middle of a volatility storm. If you pull up the one-day chart for gold, you can see it dipped all the way down to around $4,100 before recovering nearly $300 off the lows. That's a massive move in an asset people still like to call a stable store of value. So when you see gold down a couple percent and you see silver up a percent or two, don't let that fool you. Both markets are basically shouting the same message. Positioning is stressed, liquidity is being tested, and headlines are moving prices in real time. Now, a quick look at the gold-silver ratio helps frame what's happening. The ratio is moving lower today, mainly because gold is down while silver is bouncing. But even after moving lower, the ratio is still above 60. And the reason people watch that is because it can influence how they think about value between the two metals. When the ratio is high, silver looks cheap relative to gold. When the ratio is low, silver looks expensive relative to gold. Above 60 is still historically elevated in many frameworks, which is why a lot of buyers look at this and say, this is still a zone where I'd consider owning both. But here's the bigger question. Why did we get such an extreme reversal? Why did we see a downtrend accelerate and then suddenly snap back? One explanation that's getting a lot of attention is that a big part of the move was headline-driven. Early losses in precious metals reversed sharply after renewed hope that tensions might cool off. In other words, some traders saw a path toward de-escalation, and that shifted risk positioning quickly. Markets don't like uncertainty, but they also don't like being one-sided. When everyone crowds into the same trade, and then a headline hits that suggests the worst-case scenario might not play out immediately, you get violent whipsaws. A major catalyst cited was a high-profile social media statement posted early in the morning, suggesting a temporary delay in certain military actions for a short period. And whether you like that source or not, markets clearly reacted to it. You could see it across multiple assets. Metals bounced, and the entire risk narrative shifted for a moment. Now, to be clear, that doesn't mean the trend is magically fixed. It doesn't mean the next move is guaranteed up. It just means the market was primed for a sharp reaction, and that headline provided the spark. The snapback was real, but the environment is still unstable. And this is where it gets interesting. The low silver printed today was roughly half of the intraday peak silver hit earlier in the year. If you remember that spike, silver's intraday high back in January was around $122 an ounce. Today's low near $61 is basically the half back level of that move. Traders often watch levels like that, not because they're mystical, but because human behavior clusters around them. Round numbers and major retracement zones can act like magnets. So, does that mean $61 is the floor for silver? Maybe, maybe not. Time will tell. A level can look like a floor until the day it isn't. But it is absolutely a level that people are going to remember, and that matters because memory shapes future order flow. There's another perspective that adds context. Look at where silver was 1 year ago. Around this time last year, silver was roughly $33 an ounce. That means even after all this chaos, silver has essentially doubled over a 1 year period. That's an incredible move in any asset class. The problem is the path it took to get there and the path it's taking now is not smooth. It's a roller coaster, and lately it feels like the coaster is running without brakes. And that's why the 1 day chart looks so insane. You see $69, down to $61, back up into the high $60s, inside hours. This is the kind of tape that burns both bulls and bears. Bulls get shaken out on the flush, bears get squeezed on the rebound, and anyone using leverage is basically playing with fire unless they have strict risk controls. Now let's talk about the macro piece that sits behind a lot of this: interest rates. Earlier, the metals were dealing with a big headwind because markets were starting to price out rate cuts and even flirt with the idea that hikes could come back due to inflation. But that narrative has shifted, at least slightly again. The probability of a near-term rate hike has dropped. Right now, the odds of the central bank raising rates at the next meeting are closer to about 10%, which is lower than where they were recently. And when you look out toward the end of the year, you can see a much higher probability, around 70%, that rates stay where they are. That matters because one of the biggest short-term pressures on gold and silver has been the higher for longer mindset. When yields are high and the dollar is strong, precious metals often struggle because they don't pay a yield. The opportunity cost of holding metals rises when cash and bonds pay more. So if the market begins to believe hikes are less likely or that tightening is off the table, that can relieve some of the pressure. At the same time, it's not a clean bullish signal. There's still uncertainty, and there's still a chance of a rate cut before year end, about 10% in this view, which tells you the market still sees multiple possible paths. Anything could happen isn't a satisfying forecast, but it's honestly closer to the truth in a period like this than fake certainty. Now let's pivot to something that doesn't get enough attention compared to price charts: physical supply. There's a chart that's hard to ignore. U.S. exchange silver stockpiles have been depleting for years. The visual is clear. Available inventory has been draining. And when people see that, the natural question is, where is the silver going? Because on one hand, you hear narratives about silver being critical, about strategic importance, about industrial demand, and about governments needing secure supply chains. Some people even assumed that if silver is being treated as a critical input, you'd see more domestic stockpiling. But the inventory trend suggests the opposite. Metal is leaving. So where is it going? A straightforward answer that's been circulating is that recorded physical flows have been moving east, into places like India, Hong Kong, and the United Arab Emirates, with China also playing a major role. That's important because it suggests the demand isn't disappearing, it may be relocating. And if you look at reports of overseas purchases, you can find claims that China's overseas silver buying has surged to the strongest levels in years, an 8-year high in one widely shared data point. If that's accurate, it fits a pattern that's been building for a long time. When the West panics and sells, the East accumulates. It happens in other commodities too. Strong hands buy when weak hands need liquidity. Now, does that automatically mean silver must explode tomorrow? No, physical flows matter over time. Futures markets can push price around in the short term far more violently than physical supply and demand would suggest. But sustained inventory draws and sustained import demand are the kind of fundamentals that can tighten the market quietly in the background while price action looks chaotic on the surface. This is why you can have a situation where silver looks cheap relative to a prior peak and still feels expensive in absolute terms. If a major buyer believes the long-term story is intact and the current price is a discount relative to where it could go, they'll buy. They don't need it to feel comfortable, they just need it to be available. And that brings us to the longer-term technical narrative some analysts keep repeating, that silver's multi-decade breakout is still intact. The argument goes like this. Silver's historic peaks were in 1980 and again in 2011. For decades, those highs capped the market. If silver has broken above those multi-decade resistance zones and is holding above them on a long-term chart, then the breakout still holds, even if price is violently correcting in the short term. Under that framework, the current chaos is a shakeout inside a bigger move, not the end of the story. There are even bold projections tied to that thesis. Targets like $250 to $300 per ounce over the next year or two, possibly into 2026. That's a huge call. It's the type of target that sounds insane until you remember silver has already shown it can go vertical, and it has already doubled in a year in this very cycle. Does that mean those targets will happen? No, but it tells you what kind of psychology exists in this market. People are thinking in extremes because the volatility has trained them to expect extremes. Now, gold's behavior today raises a separate question. Many people look at global tension and expect gold to rise cleanly as a safe haven. Historically, gold often does respond that way during crisis moments. But this time, the response has been messy. And one explanation is that this isn't a simple fear trade. This is a macro collision. The dollar has been extremely strong. Oil has been surging. Yields have been elevated. And when those variables move the wrong way for gold, it can distort the normal wartime script. Instead of gold catching an immediate safe haven bid, you sometimes get forced liquidation. Funds sell what they can sell. If they're raising cash, they sell winners. They sell liquid assets. They sell what they can. That can include gold. There's also the positioning angle. Another widely shared idea is that a huge portion of gold trading positions are underwater right now. When most participants are underwater, two things can happen. Either panic selling accelerates and you get one more flush, or the selling exhausts because there's simply no one left willing to sell at those prices. And then you get a violent snapback when buying returns and shorts cover. We saw a version of that today when gold bounced hard off the lows, but it didn't turn green. It recovered, but it didn't fully reverse. That's still consistent with an unstable market, where the bounce is real, but the conviction is not yet. A fair question that keeps coming up is, how does it make sense that precious metals can take one of the biggest hits across asset groups right when war risk rises? Shouldn't metals be the winners in that environment? In the short term, it can make sense when you factor in the mechanics. If the conflict pushes oil higher, inflation expectations can rise. If inflation expectations rise, rate cuts can get priced out. If rate cuts get priced out, yields rise. If yields rise, the dollar strengthens. If the dollar strengthens and yields rise, that's a toxic mix for gold and silver, at least temporarily. Add in leveraged positioning and you get liquidation cascades. So the short-term price action can look wrong from a simple narrative perspective while still being totally explainable from a market structure and macro perspective. But then comes the longer-term argument, and it's hard to dismiss. War tends to blow out deficits. Even if the immediate market reaction is messy, the second and third order effects of prolonged conflict often include larger budget deficits, higher food and energy prices, slower growth, rising unemployment risk, stress in stocks and real estate, and, in the worst case, a financial crisis dynamic. If you were bullish on gold before, the argument is you should be even more bullish now. Not because gold must go up every day, but because the conditions that push governments toward more borrowing and more monetary accommodation tend to be supportive for hard assets over time. And when you look at the numbers, it's easy to see why that narrative persists. The U.S. national debt is now above $39 trillion. Federal spending has pushed beyond $7 trillion, and the deficit is around $1.7 trillion. Those are enormous figures, and they're not taking place in a world that's calm and stable. If geopolitical tension drags on, do you honestly expect that spending trajectory to improve quickly? Or do you expect more emergency packages, more borrowing, more temporary programs that become permanent? This is why a lot of long term holders keep coming back to the same conclusion. They don't want to sit in cash for the long run. They'd rather own real assets that can potentially protect purchasing power. That doesn't mean you ignore volatility. It means you accept it as the price of admission. Now, let's get real about the short term, because this part matters too. The volatility is not normal. 7, 8, $9 swings in silver inside a few hours used to be rare. Now it's happening regularly. People who've been watching silver for years remember when a 50-cent move felt exciting. A $1 drop felt like a crash. Today, silver can move $10 and then reverse, like it's nothing. So if you're expecting calm, you're in the wrong market at the wrong time. The most honest expectation for the near future is more volatility, more headline driven spikes, more flushes, more sudden rebounds that feel impossible. And that means anyone participating needs to be careful about position sizing and time horizon. If you're trading, this kind of tape can destroy you if you don't have discipline. If you're investing long term, this kind of tape can shake you out if you're emotionally attached to the daily price. Both groups can lose for different reasons. Personally, the way many long term buyers think about it is simple. If prices keep dropping and the long term thesis hasn't changed, they treat it as an opportunity to accumulate. Slowly, not recklessly. Not by going all in on a single day, but by averaging in over time, keeping dry powder and letting the market come to them. Because nobody knows where the exact bottom is, and this market is proving that it can overshoot in both directions. And that's the balance: short-term uncertainty, long-term conviction, if that's your framework. The bigger takeaway from today isn't just silver bounced. The bigger takeaway is that the market is behaving like a pressure cooker. Physical supplies appear to be tightening and moving overseas, while paper markets are whipping prices around based on rate expectations, dollar strength, and war headlines. That combination can create the most extreme kind of trading environment. Fundamentals pulling one way over time, while liquidity and positioning yank price the other way in the short run. So the question becomes, what happens next? Do we look back at that $61 print and say, that was capitulation, that was the flush, that was the floor? Or do we say, that was only the first major wave, and we'll see it again? Do gold and silver stabilize as rate hike fears fade and the market settles down? Or does the next inflation print, the next oil spike, or the next geopolitical headline send everything into another spiral? And on the physical side, if inventories keep draining and large overseas buyers keep accumulating, at what point does the paper market stop being able to ignore it? That's what I want to know from you. Do you think today's reversal is the beginning of a bigger rebound or just a temporary bounce inside a larger correction? And if you had to pick one dominant driver for the next few months, dollar strength, interest rates, or war/energy inflation, which one do you think will matter most? General note, this is commentary/education, not financial advice. Markets are risky, especially silver in this kind of volatility.